When prices are skyrocketing, we all look for a hero. And in the world of finance, that hero is supposed to be the central bank, like the Federal Reserve or the Fed. But what if I told you their main weapon for saving the economy is to purposefully slow it down? It sounds counterintuitive, but to fight inflation, the Fed has to make life more expensive for everyone on purpose. This is the one moment deeper dive. First, let's remember why inflation is happening. It's often a demand-pull problem. Too many people with too much money are chasing too few goods. The economy's engine is overheating. The central bank's job is to be the adult in the room and cool the engine down. They can't print more goods or fix supply chains. They only have one very blunt tool: interest rates. You'll hear the term the federal funds rate. This is the one rate that rules them all. It's the interest rate that banks charge each other for overnight loans. You might think, who cares? I'm not a bank. But here is the ripple effect. When the Fed raises its rate, it becomes more expensive for your bank, like Bank of America, to borrow money. So what does your bank do? It passes that cost directly on to you. Suddenly, the interest rate on your new mortgage skyrockets. The rate on your new car loan jumps up. The rate on your credit card debt becomes crushing. Now, what do? You stop thinking about buying that new house. You decide to keep your old car. You cut back on spending to pay down your credit card. You and millions of others stop spending money. And just like that, demand collapses. With fewer buyers, car companies can't raise prices anymore. Home prices start to fall. Businesses see their sales dry up and are forced to stop raising prices. Inflation cools down. That is the entire plan. The central bank fights inflation by making borrowing money so expensive that it forces everyone to stop spending. It's an unpopular and painful medicine, but in a dangerously overheated economy, it's the only one they have.